Loan rejections for some applicants can negatively affect the chances of others who have not yet applied, even when their finances and credit histories are separate and unrelated. This downside connection might seem surprising because loan decisions generally focus on the individual applicant's ability to repay without directly considering unrelated applications or external factors. The main mechanism involves how lenders manage overall risk and regulatory capital requirements, meaning they evaluate the combined impact of all loan applications on their financial stability. Earlier loan rejections indicate potential risks or resource limits to lenders, leading them to adjust approval standards, which affects new applicants by raising lending requirements and criteria. This adjustment creates spillover effects where new applicants face stricter scrutiny, even if their individual risk appears low, as lenders aim to maintain capital adequacy and manage exposure. Consequently, earlier rejections indirectly reduce the total lending capacity available, encouraging lenders to be more selective with later borrowers to control overall risk and losses. This process illustrates how individual loan decisions are connected through systemic constraints and collective risk management. So one applicant's outcome partly depends on others' loan experiences. Loan approvals reflect not only personal evaluations, but also ongoing adjustments to changing incentives and limits within the broader lending system and market conditions. Lenders operate within regulatory frameworks that require maintaining certain capital ratios, limiting how much risk they can take on at any given time across all borrowers. When earlier applications are rejected due to risk concerns, lenders may tighten standards to avoid exceeding regulatory risk limits, affecting approval thresholds for future applicants. These tighter standards often mean higher credit score requirements, lower debt-to-income ratios, or more documentation, which can create barriers even for otherwise qualified new applicants. Lenders also consider portfolio risk, meaning the aggregate risk of all loans they have outstanding, which influences their willingness to approve additional loans at any time. If a lender's portfolio shows increased risk from recent rejections or defaults, they may become more conservative in approving new loans to balance their overall exposure. This balancing act reflects trade-offs between lending enough to generate returns and limiting the chance of losses that could harm the lender's financial health. Credit risk models used by lenders incorporate data across many applicants, so patterns of rejection and approval affect how future applications are scored and evaluated. When rejection rates rise, models may signal higher risk in the applicant pool or economic environment, prompting lenders to adjust criteria for all new borrowers. These adjustments can include raising minimum credit scores or requiring larger down payments, which influence the likelihood of approval for new applicants across the board. The timing of applications matters because lenders update risk assessments frequently, meaning recent rejections can immediately impact lending policies and decision frameworks overall. This temporal connection means that loan outcomes are not isolated, but part of a dynamic system where each decision contributes to overall risk management. Additionally, economic conditions such as interest rates and market volatility interact with lender risk policies, influencing how earlier loan rejections affect subsequent approvals. During uncertain economic times, lenders may become more cautious, increasing the influence of past rejections on new application evaluations and lending criteria. Borrower behavior also plays a role, as trends in defaults or late payments can lead lenders to tighten criteria, indirectly linking earlier rejections to future approvals. Lenders balance incentives to extend credit against the risks of overexposure, so earlier rejections serve as signals prompting recalibration of lending strategies and standards. This recalibration helps lenders avoid excessive losses, but also means some new borrowers face tougher requirements due to factors beyond their individual profiles. From a systemic perspective, loan approval patterns reflect collective risk management rather than isolated evaluations, showing interconnectedness within the broader lending ecosystem. Understanding this interconnectedness clarifies why borrowers applying at different times may experience varying approval chances influenced by prior loan outcomes and market conditions. Though each application is unique, the broader lending environment in recent history of approvals and rejections shape the context in which decisions occur. This environment includes lender policies, regulatory constraints, economic factors, and portfolio risk, all interacting dynamically to determine loan availability and terms. In summary, earlier loan rejections affect new applicants by influencing lender risk assessments, capital management, and approval standards within a connected financial system. Recognizing these mechanisms explains why loan decisions reflect systemic risk considerations and ongoing adjustments by lenders, not purely individual evaluations.